A very good evening, everyone. Welcome to Admiral Markets. Welcome to this webinar on how to plan your trades in the Forex market. So glad you could join us today on Thursday. And before we start, of course, the risk disclaimer explaining that trading in general, Forex and all financial products is considered high risk. It may not be suitable for all investors. Please seek the advice of an independent financial advisor for more information on that. And this webinar is for educational purposes only. So thank you for your attention on that. Welcome. Once again, this is hosted by Admiral Markets. My name is Chris, and Nennet and Michael are here with me as well. And we'll be presenting this together. We're going to be taking a look at all the ins and outs on how to make a trading plan. But first of all, I want to welcome Michael. Good evening.
Good evening, everybody. Good evening, Chris. Good evening, Nana. It's very nice to see all of you here today. We have a fantastic crowd who gathered today to watch our webinar, and I'm very confident we are not going to disappoint any of you today. My name, as always, is Michael Onahov. I'm a client relationship manager for Admiral Markets. Here's my email, my Skype, my LinkedIn, and also an email for our educational 3-week online course called Trading Camp. If you wish to get fantastic Forex education, write to me at camp@admiralmarkets.com and I will help you out with huge pleasure. Today I wanted to speak to you about decisions. Before we start with the whole webinar with serious concepts, let's take a small detour and speak about something which is very important, of course. By something, I mean decisions, because your success in the financial market and in life in general is determined by the decisions that you make. However, different financial activities require different amount of decisions. In some circumstances, all you have to decide is which trust fund will manage your investment. Some decide to construct a portfolio themselves and are faced with choosing, say, 20 different types of equities to suit their long-term investment objectives. Some decide to actively manage their portfolio and adjust their investment from time to time to remain, say, either beta neutral or heavily beta exposed. Forex market, of course, is the Cadillac of decisions. You are faced with a huge amount of decisions every single hour, minute, and second you spend logged into your MetaTrader. What currency pair to choose, what limits to set, if any, to close a position with a small profit or loss, or leave it open expecting the market to make you a huge favor. There is no other financial activity that would put your decision-making skills to a test quite as often as Forex will. In fact, you are faced with an important decision as soon as you decide to register. There you are, typing your name and your email when you're kindly asked to decide which account type would you like to open. Remember the first time you went to Starbucks. You come in for a coffee. That is pretty much all you want, just a coffee. Suddenly, you're faced with a huge amount of choices and you have to make one on the spot. You have to choose between hazelnut cappuccinos, vanilla lattes, and chocolate frappuccinos. Each of them comes in 3 different sizes too, and you cannot get a medium or forget about it, a large coffee. It has to be a venti or a grande or tall or something else. The first time I was in Starbucks, my embarrassment lasted for a whole 15 minutes. There were too many choices. Later on, I went to Subway for a sandwich. Just a sandwich, nothing fancy. Needless to say, I was late to work for about an hour that day. So some Forex brokers, they do the same thing with decisions. And after you type in your home address, you must choose between 14 different account types. There's a lot of different account types to choose, and those decisions can be very difficult. However, we at Admiral Markets decided that we must have your interest in mind all the time, your best interest. Therefore, we decided to keep it very simple, short, and sweet. You get to choose between a standard and a pro account. So if you wanted to open a real account today, this information is going to be very helpful. I'll tell you the differences and the essential truth about 2 different account types, standard and pro. First of all, we have the standard account. The choice is not as difficult, but it's very important. First of all, you must consider your financial objectives. If you are new to Forex and would like to see if you have what it takes and you know what it takes to be a financial trader, think no further. Standard account is the one for you. The minimum deposit starts at just $10 and all of your needs will be accommodated. You will have 30 pairs to trade, you have CFDs as well, and you have a nice leverage up to 1 to 500. Then there's also an Admiral Pro. Now, the Admiral Pro account is a little bit different. You get fractional pips. The minimum deposit starts with $1,000. You have 27 pairs, no CFD, and you have a leverage of 1 to 100. If you're thinking about opening a Pro, you can put the entire thing into perspective. Look at those two cars. Now, this is a Porsche 911. It's a fantastic car, looks beautiful, very fast, quite expensive, but that's okay. For a financial trader, everything is achievable. So this kind of a car is like Admiral Standard. Now look at this car. This is a Porsche 911 Turbo, and that's a Gran Turismo car. Now this one will be even more expensive, even though a lot of stuff has been taken out of it to make it lighter. So this one is not as comfortable, but this is a lot faster. This one is very fast as well, not as fast as the previous one, but very comfortable. This is like your Admiral Standard, and this is like your Admiral Pro. So Admiral Pro is like a sports version of a production car. We throw away extra things to let you go faster. And then there's also a higher charge and a higher minimum deposit. So those are two main choices available to you. The good news are, none of those choices will result in any financial loss. They are not even final. Once you have your account open, you can open up to 10 different trading accounts. You can use your standard account to bet on DAX and then switch to your Pro account to long yen versus dollar. The choice is always yours. What is important though, we made it our responsibility to at least one of many choices as easy as possible for you. Thank you very much for your attention. I will now pass the floor back to Chris and Nana. Thank you very much, guys.
Yeah, thank you too, Michal, for that great introduction, in fact. And talking about choices, it's actually very, fits very well in the topic of today, in fact, because creating a plan and making a plan is everything about making easier choices for a Forex trader, let's face it. It's definitely true. Forex traders, we bump into trading decisions actually almost every single minute, depending on how intensive you trade, and sometimes actually that is not too good for trading, is it? Because that leads to maybe bad decisions and impulsive decisions that are in fact not optimal and hurt equity and profitability. And that is why trading plan and having a trade plan helps with that, because it provides us guidance when to make decisions, first of all when to make them, and then how to make them, and also eases the relative pain we do have a bit when trading and there's a loss. Let's face it, losing is not always nice, or never is probably, but it's part of the game in Forex. We'll always have losses, and it helps us with the psychology as well, because if we have a loss, we follow that trading plan, then we can have relief in the fact that we followed our trading plan. And in the long run, our trading plan should bring us to profitability, even though we might have one trade or one day loss or even a week loss, right? That's all part of the game and battle. So by following a trading plan, we can soothe our own psychology in a way. So today we're going to be talking about what is a trading plan, why have a trading plan, how to make a trading plan, and all these things. So glad that you could join us. I was scared maybe that today's topic could maybe not be as popular among traders, but I see there was a good turnout today, and I think it's definitely an important topic. Because it's kind of like a serious topic. It's not as maybe as fun as some of the topics could be, like indicators and whatnot, but I think this is definitely worth the time. So a trading plan, what is it? Ned will be talking about that later on too. I'll just be sharing a few slides first regarding these 5 things. Basically, a trading plan is kind of like a coherent approach, a system, a work method for the various roles you have. Basically, as a Forex trader, we have different caps, we have different thinking caps, we have different roles all in one. In a company, right, we've got all these tasks split. You got a risk manager, you got a trader, you got the analyst, you got the manager. You know, you have all these things. These tasks are delegated and segregated as well, so that everyone can fulfill that particular task to their best. Whereas forex traders, retail traders, we are more limited in the sense that we are doing that all in one. And you know, if we make a mistake in our trading plan, there's no big old boss telling us, you know, or you did something wrong, Chris, or your name. You know, why did you enter there? Why did you exit there? That's not according to our plan. That's not according to our strategy. There's these kind of nasty talks we don't have to have, but we should have with ourselves, in fact. So, but you know what I mean. This is all on us. So we have to be our risk manager and our boss and our implementer, our doer, our thinker, all of it. And it all is combined in following. The plan should incorporate risk management elements, trading strategy elements, money management elements, trading psychology elements, documentation, and evaluation. I think most of you know this. If not, it's definitely vital to keep an eye on these 5 things, because this is basically what it all boils down to. I mean, there could be other things, important things, but I think that more or less covers, these are the aspects we need down pat covered to have a coherent plan that would lead to successful, I mean, consistent profitability. Sorry. Consistent profitability. So once again, risk management, money management, trading strategies, trading psychology, and documentation and evaluation. So Forex, is it a bit like the strategy of chess? Now, I don't want to scare some of you off, because some of you might think that the chess is, you've never tried chess because you think it's too complicated, or you've tried it and you just don't, you know, see anything in it. That's fine. I don't want to, it's not, the point is not to scare you. It's just to show you the diversity of trading. That's all in forex trading. Because I do think, yes, I do think that it has a bit of chess. Chess has strategies, and I think forex has strategies as well. Maybe chess is for some of you a bit more boring. That's fine, but they do have that side to it, right, where you're developing strategies. Now the forex, of course, has its differences. The chessboard is put back to a standard neutral position that is fixed with the same pieces everywhere, with the standard game at least, as far as I know, you know, every time. The forex market doesn't really reset itself. I mean, it does reset itself in the sense that at the beginning of the day, at the beginning of the week, where you have new levels, new key levels, new intraday levels, and that's the new playing field for the day. So yes, even that resets itself, but it has a history, whereas chess has a history maybe too, in a way that you've played against a different player several times, and last time he played that way, so I will play that way. You know, so even that is similar. Another thing forex trading could be very similar is maybe the money management of poker, for example. I mean, often enough you see a lot of poker players dive into trading, for example, or you see a lot of chess players and backgammon players go into poker. That happens often. So here too, you've got that money management perspective of poker that is important to create that edge in trading as well. Is it maybe the psychology of a pro sportsman, for example? Yeah, I think so. I think that if you're playing, this is any pro sport. I mean, I found this picture interesting. That's why I personally don't play golf. But you know, if you're standing on the green and there are 5 people watching you, 100 people watching you, there's a TV camera pointed at you, you feel that pressure. I was playing squash yesterday, and you know, you have those psychological moments. I'm up 1-0 in sets. I lose 2-1 because I felt that I must win that set. Whereas I was down 1-0 and almost losing the second. I was really almost knocked out. I came back 1-2-1 out of the blue, really like a miracle comeback. You know, so it's really strange how psychology can really influence the mind and results, and forex trading is not different at all. Definitely very important. So to me, everything together is like a house, the house of forex, and the house looks like maybe like this. The risk management could be the floor, the red bottom there. Without it, basically our house is collapsing. In Forex trading, if we don't have risk management, we're risking our entire trade capital. And without trade capital, we don't have stock. Without stock, we cannot trade. Forex strategies are like the windows of the house. With it, we have a vision of our surroundings. We have a clear sight of what we want to use in our trading and what parts we don't want to use it, right? Basically, when looking at price action, you can see a lot of things. The trading plan is the filter and filtering out what action we actually use and what price action we don't use. With strategies, it provides us to the window of opportunities. Without those windows, we can't see. We're blind. All right, so that's why the windows are important, and that's why risk management is the floors, in my opinion. The walls are kind of like psychology. I mean, without the walls, the house, you can't have a house without a solid foundation. Let's face it would just collapse. You can't have a house really. Yeah, you could have a house maybe without windows, but it's really not too functional. You can't have a house without the walls because without a good support, it just will crack eventually. Maybe not right away though. If your walls are not fully developed and full built, maybe it will survive for a while, just like our own account. But eventually you'll see the cracks in the walls and in the account if you don't have that good psychology. And the money management I found was the roof. And not to say that the roof isn't important, but if there's a hole in the roof, a few drops is not going to necessarily make it. I mean, it will be not so pleasant, but you could survive there for a while. And I think that without money management, basically, you see often enough Forex traders hanging around break even. They make some, they lose some. They have good strategies. They have good risk management, but it does really edge forward. And sometimes the problem could be money management, which is like the roof, I thought. So that was just my way of sharing what I thought was fundamental and key for trading. And then it's going to take you now through some first steps, in fact.
Thank you, Chris. Yeah, there are also some steps that we need to take in order to get our potentially good trades done. It's not just about system, it's not just about strategy or method. We need to have a proper plan. Sometimes even our plan can fail, but it's not up to us always. But we need to have how can I say, a plan because of disaster avoidance. We need to do that. So the first steps, what we should undertake are basically that we should learn our system, strategy or method. It's called also skill assessment. So skill assessment will give us basically few answers. Are we ready to trade? Have we tested our system on the demo account, and do we have a confidence that it works? Can we follow the method without hesitation? Well, guys, always trading in the markets is a battle of give and take. So the real professionals are prepared, and they take the profits from the rest of the crowd who obviously lacking the plan give their money away through very costly mistakes. So that is the first step, skill assessment. Are we ready? Do we have a proper skills? Do we have proper arsenal? Then we need to have a good emotional and mental preparation. Are we feeling good? Did we get a good night's sleep? Maybe we don't feel up to the challenge ahead. So if we're not emotionally and psychologically ready to battle in the markets, so it's better to take the day off. Otherwise, we are risking to lose the profits. So, and many times that will happen. We will be very uncertain, angry. Maybe we will suffer from hangover. So many traders have, I can say, a mantra they repeat before the day begins to get them ready. So we need to prepare ourselves mentally. It's called psychological preparation. Then we need to think should we build an account or trade the account? And this is also important thing which many traders, even some professional traders, do not understand. I have been so far in my trading career, I have witnessed and I have met many traders really across my own trade, Forex Factory, Euro-Dollar trade and Forex Factory, where we have over 30, 40 millions of visits. So I have met every kind of traders. One of successful trader had a debate with me about this particular part. And I told him, and that is of course my opinion, there is difference if we build an account and we trade the account. And I have personally witnessed that difference, because from time to time, I, being a professional trader, of course Chris along with me, we are, guys, we are basically working on our accounts, but we are also working on, from time to time, on others' accounts, right? So there is a big difference, really, because when you have institutional account, and I think that Chris will surely agree with me, when you have an institutional account, that means that you don't trade 10,000, 20, 50,000. Usually, institutional accounts start with 100,000 of units, whether it be dollars, euros, or pounds, British pounds. Those are basically the lowest accounts possible in institutional trading. So let's say that you have that lowest account, $100,000 of dollars. Okay, you don't need to build that account. That account has already been built for you. It's prepared for you. Whether you have one single fund of 100,000, or maybe you have, for starters, 10 traders, where you basically put into a big pool of $100,000 and then you trade it. So basically you have the account. You don't see each account separately. You have a account pool. You have those money on the stack. So basically you have the account for trading. Now, when you trade the account, the psychological and risk management difference is big, a lot bigger and a lot different when you are building an account. Building an account, if you want to build your account from $10,000 to $50,000, you need to take a bigger risk. And now, believe me, I know what I'm telling you. You need to take a bigger risk. You can do it slowly, okay. You can go with very, very slow. Then from time to time, you would need to step ahead. And I don't mean about avoiding your trading plan. But if you build an account, from time to time, you would need to step in with certain choices that can affect your general rule for trading. That is because you are building an account. And when you have the account ready for trade, then you should never step out of your usual routine risk management. So there is a big difference of building an account and trading the account. You trade both accounts. You trade that future account which needs to be built, and you trade the account which has already been built. So that is basically those are things that you need to adopt before trading, guys. If you start with $300, then obviously you will need to build an account. Okay? So basically, all of your questions and comments will be answered after we finish our webinar, so don't worry about it. Okay? And that means basically that we will be undergoing our next step. That is, analyze your risk. So we need to analyze our risk, and that risk again, it depends whether we build an account or we trade the account. If we build the account, that risk will be bigger. If we trade the account, if we trade the built account, which we will use for withdrawing the money and for our living, then that is a completely different thing. From $100,000, you can withdraw the money which you will use to pay your bills. From $10,000, it's very hard to withdraw the money each month, because it's not big money. $10,000 in Forex market, it's not big money. So, but not just in Forex. Maybe now someone will tell me in our country, or I don't know, in some countries $10,000 is big money. I have a lot of experience. I also traveled from time to time. I travel across Europe, visiting some countries. In Europe, $10,000 is not big money, and you cannot live if you have $10,000 and you want to trade it for a living. That is not possible. So that, again, we come to the fact that we need to analyze our risk. If we want to make 10,000 more, we need to set the risk level a bit higher. If we have 50K or 100K, then we can basically lower our risk, and we can make a nice living from 3 to 4%, right? If we read through calendar, we need to watch always for those fundamental shifts. If you have followed, let's say, my analysis from yesterday, where I put that we need to short euro dollar, indeed on 34.20 at the break, we did that, and we had basically our winning trade touched 33.90. I pointed 33.85, but that was not the problem. The problem was that after that we had a potentially long trade, and I got into a long trade. After that short trade, I got into a long trade, and I was sure that I will, well, you cannot be 100% sure, but I was 90% sure that this trade will be going in my direction. I got some 15 pips, and then I was spiked out. I think the move lasted 5 minutes, and my stop loss has been spiked out like it has never existed. I read through the calendar, and I couldn't find what was happening, really. I couldn't find it. And it's very, very, very unusual that something happens and that, let's say, Forex Factory or Forex Street calendar doesn't show. So we need to watch other websites. Let's say we need to watch out for those speeches. And what happened yesterday is that ECB member was talking about possible rate cuts on euro dollar, and that only that single sentence shifted our trade from a positive to a negative trade. And now someone would ask me, what would happen if I risk a bit, if I put, let's say, a bigger volume on our trade? Let's say that we have risked a little bit of much. Okay, what? Now that's a paradox. A little bit much. It cannot be said like that, but I said it. Okay, we risk a little bit more than we should risk. Maybe if we trade the account, institutional account, or a built account. Well, what happens is you need to be psychologically prepared for that. Even if we read through the calendar, we need to know that fundamental analysis. Sometimes those unannounced things may turn the tides in their favor, not in our favor, and we will lose. So even if we read it carefully, if we know, and you should always do that, always check your calendar, always, and I mean it literally. Sometimes that single thing will slip away and basically kill our trade, even though later I longed again that euro dollar, because I knew that that was basically a rumor. That was sell the rumor, buy the fact. You have probably heard that sentence in Forex market. Sell the rumor, buy the fact. The fact is that markets when it touched 33.85, that market, particular euro dollar, was bullish. After touching that level, the market went bullish. That was the fact. The thing that ECB may cut rates next meeting or apply negative rates, that was a rumor. That was unconfirmed. So I was trading the fact, but something slipped away. And stop loss, even if I put that stop, let's say my stop loss was 34.05, it went again to 33.80 something. After that, I was really a little angry, but not angry because I knew it will go higher. And then I again risked maybe a little bit more, and basically what happened is that trade went successfully to the upside. But I don't like when that happens, but I'm prepared for that. So I don't like when it happens, but I'm really prepared for that. And basically the thing is, always prior to your trading, read through the calendar. Don't trade when announced news will come. Don't trade when conferences, that can be really nasty. Yet again, we need to keep the track records. We need to always keep the track records. So we need to see where we made mistakes. If, let's say, we win a trade, we want to know exactly why and how we won the trade. We want also the same when we lose, so we don't repeat that unnecessary mistakes. Try to write down details such as targets, the entry, the exits of each trade, the time, support, resistance levels, daily opening range, market open, close for the day, or use indicators which show you. So try to save your trading records so that you can go back and analyze the profit or loss for a particular method or system, to analyze drawdowns, average time per trade, and other important factors. So don't forget that this is the business and you are the accountant, okay? So that is why you need to have the track records always available for you to read. So those are very first steps which we should undertake in becoming a pro trader, okay? Then we go to the next step, planning our trades. First thing to do is we need to analyze the market. And I know that many of you are basically beginners, right? So guys, if you're not sure about your analysis, okay, then try to employ a professional trader. Try to read through our, let's say, our blogs. Chris do that for you on his live webinars. I do that for you for session recaps, and of course Admiral Markets blog page. So I think that we help you, each with his own way of trading. Chris live trading, I with my analysis. So if you're not sure, then why not try to listen to someone who knows, someone who basically is a pro trader and someone that you believe in, okay? Next thing to consider is that each trading plan, and trading plans generally contain checklist. To put it simply, you need to have a routine in your trading activities. Otherwise, you will just end up running and gunning the seat of your pants. I need to say that. I also explained that acronym when we talked about basically army soldiers. That when you have a sniper and you want to make a guerrilla war. So if you remember a webinar, I won't go through that, but I will just say the one simple thing. If you want to be a precision trader, not a machine gunner. Machine gunner kills everything. He kills flies, he kills air, he kills soldiers, enemy soldiers, everything. Sniper is very precise. you need to be disciplined. Sniper in the military is extremely disciplined individual. So you need to think of the Forex market like it's a war, and that you are a professional sniper soldier trying to take only the easiest prey. That is why I'm called Tarantula, one of the reasons. If anyone asks why my nickname is Tarantula, one of the reasons is that I'm a stalker. I prey the prey. I don't shoot out randomly. I'm not a machine gunner. I'm a sniper. Let's say I can call myself a killer spider because I first stalk the prey, then I kill it from behind. Because market is the war. If you let that enemy, in this case, you need to respect your enemy. But if you let that enemy stabs you on your back, you will be killed. Your account will be over. So you need to become from the victim to the professional stalker, professional market killer. You cannot kill the market. Market will always exist. But you can take its finger, you can take, now I'm talking, you know, it's not literally, but you understand what I want to say. You need to respect the market and to take the parts of it, because you will never kill it, but you are the stalker. You hit and then you run, but not run in literal sense. You just go back in shadows, okay? And you will wait for another prey. In this Forex market, our preys are Euro dollar, Australian dollar, Euro yen, GBP, Swissy, GBP, Australian dollar, whatever. That creates a market, and that will shape you as a trader, okay? Traders also, I need to say, trades planned in advance work the best. Why? Because one of the main reasons to create a Forex trading plan is because pre-planning your trades and predetermining what you're looking for in the markets is the best way to profit over the long run. You will never be more objective and calm than when you're not in the market. So if you can plan out all of your trades, then you're not in the markets. You'll be totally uninfluenced by market variables when you're in a trade. And this will work for you and will protect you from becoming emotional Forex trader. Emotional Forex traders can be professional analysts, can be professional mentors, but that doesn't mean that they are professional traders. They know what they should do when they trade, but they cannot apply that on themselves. I personally know a guy from a Forex factory. I will not speak his name because it wouldn't be correct, but I know him. And that guy really is one of the most famous guys in Forex factory. He also has his own trade running, and I don't know, I haven't heard from him in a while, but I know that he also do great analysis. He also posted some great trades. He also traded with an institutional fund. But I also know that he is emotional trader. And when one of my ex-colleagues asked me what I think about that particular trader, I told him, he can work for you. Maybe he will be good in 1 month. He may be good for 5, 3, 4, 6 months. It doesn't matter. But he is very emotional. You know, Forex Factory is really the biggest site of all Forex business here in the world. It's also one of the first 1,000 websites for complete visits. Let's say that average visit in a Forex Factory count in millions, tens of millions per day. So it's one of most successful websites in all websites in the world. I think it's 1990 currently by Alexa rating. So that means that you can basically meet people who you just cannot remember what you just cannot imagine what you can meet there in Forex Factory. And even though I know that he is a good trader, he is very emotional, and half of the fund which he traded was lost after the earthquake in Japan a few years ago. Half of the fund, professional investment account, was lost in a single day. Does it mean that he is a bad trader? Does it make him a bad trader? No, it doesn't make him a bad trader. When that thing happens, do not rush to kill him. Do not rush to laugh him. You should never laugh at the guy who is losing, or a girl or trader. It doesn't matter if he's a woman or a man. Try to support him, because that can have emotional impacts on the personality. And after that, I knew he wasn't the same man. Even though he was a good trader, he was killed after that. Not killed as a person in his real life. He was killed as a trader. Even though he will be asked maybe again to lead the account, it doesn't matter. It can happen. He is a good trader. I know that. He is a really good trader. But he is very emotional. So that is one of most important things. Try not to be emotional. Try to be a pro. Try to be cool. Don't go with your emotions. That will also make you much more professional than you would ever think of. You need to be patient. That means you need to wait for the conditions of a plan to unfold. Don't force it. Patience is maybe the most important virtue that a forex trader can possess. When you're a patient trader, that means that you are not emotional trader, and I was talking with you about emotional traders. So if that guy was patient trader, he would never lose that 50K. So he is a good trader, but emotional trader. You need, that is a sort of paradox, but that is a big truth. There are many, many very good traders, analysts, but when they get into trade or when they start a trade, they get very emotional, over-emotional, and they react as they shouldn't react. A large part of trading, and perhaps the largest part, is simply waiting for an ideal price action setup or other trade setup to form in the market. I will show you that later today on particular example, how I gone into successful cable trade. I will show that patience, how being a patient can do wonders for you, even though maybe some of you or me 2 or 3 years ago would rush in a trade immediately after we see the charts. Make sure you stress the importance of patience in your trading plan, and that way you will be reminded every time you read it why being a patient trader is so important to making money in forex trading business. Okay? So if you are too tired, don't trade that particular day. If you went for a party last night, if you went for a hangout and you suffer from a hangover, don't trade that day. Okay? That was the part about planning your trades. So I agree with Chris. This webinar may not be so interesting to you, but it is most important. And I'm glad that you have come today to listen to this webinar, because rarely a trader who works professionally would tell you these things, because it's in his own interest that you lose the money, because if you lose the money, someone will win the money. But we, me and Chris, know that we are just a part of a huge world, and we want you to be successful. And our company, which stands behind us, wants you to be successful. Okay? Next thing which can we work about? I think that it's on our next slide. Yeah, it's still me, and it's still advantages of making a plan. So now pay attention to this also. This is also important thing which many traders neglect. Learn about present market conditions. What that means is the detailed and proper forex plan is the result of comprehensive research on the present market. Traders need to learn more about the present market condition in making forex trading plans. Then they needed to learn which kind of charts are helpful or where to get latest news release, whatever, or what indicator should I put, or which system should I trade. You should learn about present market conditions. And that is absolutely true. 3 or 4 years ago, there were some, I was talking about it on, I think it was not last webinar, it was prior to our last webinar, of a successful forex system, that it was very successful some time ago, but what happened is that that particular system now is only a boost for your loss. Why is that so? Because present market conditions are very, very different than market conditions 2 or 3 years ago. When we had that dollar weakness, it was basically only sell euros, wait for rally, sell euros, wait for rally, and everyone thought they will make money every time they enter the market. Well, the conditions have changed, and market does not respect that condition anymore, and I think that I am not sure that it will happen anytime soon, guys. So don't go with past judgments, past analysis, past performance, only past performance. Past performance can be good, can be the truth, but also you need to have a present performance. You need to know about present market conditions. Also, that should be integrated in the plan. Forex plan is able to help you to cut potential losses. So we forex traders usually do maths before making a forex trading plan, because we want to figure out how much we can afford to lose. It's not about making profits. When you go in, when you enter a position, never enter with that I will make the money. It's about how much are you willing to lose. That is why you base your lot size on your stop loss. So if you're willing to risk a part of your account, then you will risk, let's say, 30 pips, but your volume size is dependent of that 30 pips. I will show that also next example. It's not a good word to say I knew. My analysis showed that cable will reach to 60.95. When I was writing the analysis, and by the time I publish it, I think it can be seen on the charts. Cable went to 60.40, and I analyzed that it will reach 60.95. Well, I made a trade, but I didn't put my entry position, entry size on based on that how much I will earn. So let's say that the plan was for the market to reach 60.90, but I didn't make my entry based on my target price, take profit. I based my entry on my willingness to lose. So if I wasn't willing to lose, let's say that I made some 25 pips stop loss, I made an entry which only took the account that stop loss. So how much am I willing to lose for that 25 pips? And it goes with your risk management. So always plan that, guys. Always plan that. Okay? These webinars are recorded, will be placed on YouTube and on Admiral Markets education site. Okay? So what I want to say is that you need to stick to your money management, and it's a great thing, a plan. It's a great thing to help you stick to money management. It will set your goals and it will help you achieve it. It will also make you look professional. Okay? Believe me, that's the truth. It will make you look professional. So those were the advantages of making a plan. And Chris will now show you what can happen if you don't have a plan.
Yeah, just a few more examples of why a plan is good to tie in what you've been already saying, indeed. I also had a slide prepared for that. And yeah, definitely. I mean, not having a plan is kind of a bit like guessing. It's never our intention to guess, of course. As Tarantula justly says, we never have the truth. We have only a percentage, a probability. But that's really what it's about, and playing that edge over and over again. But what we certainly want to avoid is just a random coin flip. We still want to trade with an edge. And the trading plan identifies where we have that edge, if it's a good trading plan, and gives us that rules and guidelines for that plan. So, you know, we don't want to be just looking at the charts and letting us being persuaded by emotions, by seeing price move one side or another, and start thinking, I think that this could be good. No, that's not what we want to do. That's not how we want to tackle the currency trading. So by that, the trading plan also takes away, that's the second point, takes away that subjectivity and maybe the emotions as well, and that ties in fact to the third point, and regarding those emotions that we don't want to just think, but we want to actually implement. We have a certain blueprint, we have a certain vision about how we want to trade, what we want to trade, when we want to trade, how we want to trade, and that's all you know, put on paper. And often enough, what you'll find is that you have a set of pages, maybe even, that compile this trading plan, but you want to definitely highlight the more important parts, the less important parts, and although the entire trading plan could become maybe complex, it could capture quite a lot of stuff. Most of this stuff, even put on paper, you'll know eventually by heart, or that would be recommendable. But eventually, you also want to be able to make a summary in a very quick fashion. Like, despite the fact that you maybe have a lengthy trading plan, you do want to kind of be able to name the key points in one sentence, let's say, or two, right? So that you can, if someone were to ask, then you could, bam, say what it's all about. And of course, then there are definitely details that are important, but that will be more specified in the entire trading plan. So the whole goal of the trading plan is that you're prepared to react to events. You have a planned reaction, not that you're just deciding it at that point in time. Where should I put my stop loss? Well, I don't know, here somewhere. I'm just giving a silly example, but it's that we're prepared. Our reactions are well guided, and we're well suited. Tarantula gave a great example of why being prepared is so important. So this trading plan altogether takes away that stress and pressure of making decisions maybe in the wrong moment when our trading plan doesn't say so. For example, let's say our strategy is a fib. We took a 618 bounce off of a fib, and our TP is just trailing stop 1 hour fractal, for example. And if you have that plan, our job is to implement that plan. But if we don't follow it, then we can blame ourselves. And by having that, it takes away the stress and pressure of maybe deciding, making a decision at a wrong point. Let's say we zoom into a 5-minute chart and we see an overextension, we see a big move up, and we start second-guessing ourselves, and we see it move down 20 pips and get nervous because of the draw back, the pullback, and click it out all of a sudden. Well, if you follow your trading plan and you have a trading plan, then you know that you're just waiting for the next 1 hour fractal, and you don't have that stress. It also helps with measuring our own performance, not only necessarily in profitability, which is of course the ultimate goal of the trading plan, but in fact our temporary goal is the correct execution of that plan, not necessarily making a profitable trade. I mean, in the grand scheme of things, we want to be profitable. Definitely, we want to be profitable, of course, but the profitability should lead from the correct execution, not from the correct guess. That's my point, that trading is a marathon, not a sprint, I'm saying there at the end. So that would be the goal. And of course, the trading plan should be profitable. If we're implementing our trading plan correctly, but at the end of the day we're not, or end of the week or end of the month, we're not making that profit, then we'd have to adjust the trading plan, of course. So some things regarding trading strategies. The trading plan is basically a framework for filtering price, right? It's the glasses we choose how to see the Forex. We could see engulfing twins at a certain area, but do we use that information at that particular time? The trading plan defines what we use and what we use for analysis, what we use for trade management, what we use for entries. Our trading plan is the key and entails, what we look at for tools, indicators, patterns, potential entries, exits, trade management, scale outs, scales in, timing, if you use hedging or not, whatever. All that is covered in that trading plan. And we need to practice that, demo trade it, forward test it, and make sure that we have that edge with the trading plan. Because that's our ultimate goal, is to create an edge, right? As we've been saying many times, you could enter at any point, and one of the best traders in the world probably could enter at any point and still make it a profitable trade, and another could have the best entry, but maybe still end up with a losing trade. So, you can really literally enter at any point in the time if you wanted to. But that's why we have that trading plan, is to filter out a moment and situation where we have that edge, and we can force the edge to make it a profit for us on the long run. Never look at one individual trade, though, right? That doesn't say anything about us nor about our trading plan. Of course, especially if the risk is kept to a reasonable level. I mean, if you're risking 80% of your trading capital on one trade, I'm just giving a wacky example, well, then that one trade will be very important, of course, and that's the pressure would increase on that one particular trade. So that's why it's important. Other things connected to that, the time frame for trends. For example, you want to have defined, I personally use one time frame for the trend, one time frame for the entry, one for the filters, which is one lower and one higher than the trend. So for example, the trend could be your 4-hour chart, the entry could be your 1-hour chart, and the filter could be your daily chart. You want to make sure that your trading plan fits your time schedule, fits your personality, fits your psychology, fits with your mental beliefs, with anything, your own personality, even your energy level, right? All these things are important. You want to focus on what type of style of trading you choose. You want to have that in your trading plan. And basically the goal, what I wanted to explain to you here, is that there's harmony in the trading plan between who you are, what you want to achieve, what type of trading you want to do, and how that ties in with the risk and money management, and if there's a good harmony between that. You want to have it in balance and that they reinforce each other. So, this is just an example of the tools that I use. A practical example of a pound-dollar downside here from earlier this month, in fact, just a week or two ago. And that's when it bounced off the 158.90 here, remember? And then we made the upside to the 618, then broke this bottom, and then we've been making a move up now. So that's what, just to give you the context. And well, my trading plan will be looking for breakouts. We'll be looking for hookbacks, stuff like that. And we'll be incorporating what risk I use at that point, what trade management, where I exit and enter, what chart patterns I look for, etc. When I deem reversals possible. All right. How I define the trend, what filters am I looking for, etc. What targets do I look for? So yeah, we're going to continue now with the plan effect. And I think Tarantula is going to do that.
Yeah, exactly, Chris. Continuing with the plan. So the plan is let's say when we woke up, this is just for educational purposes, we woke up and we want to plan a potentially good trade. And of course we aim for a good trade. The first step I will take is to determine whether the short-term trend is bullish or bearish. That means I'm not interested in those kind of analysis which many so-called analysis post on some sites, including Forex Street. Euro dollar will drop to 30 in, I don't know, 3, 4, 5 months. Who cares what will be in 5 months? Me, I don't care, really. I don't care a bit for that. Or let's say what Societe Generale Bank said 2 days ago, we project that euro dollar will come to 1.020 or something like that. I just cannot remember now correctly. For me, guys, that's nonsense. I don't care what will happen in 5, 6 months. I care what is present and what is the near future. So I want to see what the short trend term is, whether it's bullish or bearish. So I will apply one of my intraday trading strategies. I will check to see if there are any key psychological numbers, support resistance points in the near future from the time I woke up and started to analyze the charts. If there are none, I will go long or short depending on the short-term trend, because I don't want to long into resistance nor I want to short into supports, guys. You know that style of trading. I'm not interested in that, okay? So that is one of the things I would do. If there are, I will wait until the market reaches those numbers to look for a reversal. So if I don't see a potentially good setup, I will wait for a market reversal. I will trade against the trend if I find a candlestick reversal pattern with confirmation. One of those are those patterns, and I will potentially exploit the trend if the current move retraces. So that is what I would do, and that is what I will show you later on a slide. So that is continuing with the plan. So I will take the shot, whether I will trade against the trend or with the trend. But I don't want to trade it in between. I need those psychological levels to support resistance, red levels, Camarilla, and I want to see price around those levels. Then I would scan for a potentially reversal pattern or potentially continuation pattern, depending whether I made intraday trade or maybe a scalp trade. Next slide is, let me see, it's about next things what we should plan. Never trade during consolidation. You can only position for a single entry. That means that we have accumulation phase, consolidation. It can be range, it can be triangle. Those are consolidation patterns. We don't want to trade those patterns until there is a breakout in a direction, or we need to position for a single one-time entry for that day. That means we will close the trade if the opposite signal occurs. We want to try to achieve at least 20 pips per trade and set stop maximum at 35 pips. This is just the example of the plan. It's an example, so you can those numbers, you can shift those numbers. They're not written in a wall. So, but this is a plan that a trader can adopt. It's example. Momentum should correspond with short-term trend. We're looking for entry point into a trade. So if our momentum is, let's say on higher time frames we have a bullish momentum, let's say 4 hours is bullish, 1 hour is bullish, we want M15 to be bearish because it's a sign of retracement. So momentum should correspond with short-term trend. We're looking for entry point. We have a shorter term bearish but longer term bullish. That means we are undergoing a retracement. So we can find a 15 minutes entry if 1 hour is bullish and 4 hours is also bullish. Then get out of trade before major economic data is released. We should step out of trade if we have a major economic data. Don't make a trade just after the news, guys. Let's wait for the things to sell up a bit. We should always get out of trade the second we think it's going against us and the system shows the same. So we should get out of the trade, especially if we are leveraged a bit. And we should always try to set daily maximum profits and daily maximum loss size. So if we enter with a bit of leverage for that day, and that the daily maximum loss size does not allow us to make any more trades, then we should stick to that position and see whether it will be profitable or we will close it with a loss. Okay? So that is the second thing with a plan. And now I will show you a slide, I think. The next thing is a slide, and that slide will show you basically what happened today on cable. First thing, the candle. The candle when I woke up, I can see that the market is in bullish mode. This is bullish until that candle. You have the arrows. And it also, I read through fundamental analysis. I told you that I want to read through fundamental analysis. And what it said, it basically said that Bank of England will consider probably, it will consider bid rate hike in near future. So that means that cable is really supported by fundamentals, but in this particular moment I don't want to trade. My levels are somewhere above and below. So this is bullish. I want to see the candle retrace as much as possible and to find potentially good reversal candle. So second thing is I will need to wait for a possible retracement to enter the market. I will not buy it high. This candle is very high, and that particular candle, indeed cable is bullish, but I would rather wait for a retracement, even though maybe I would be tempted to enter the market because it looks so good, it looks bullish, and I'm sure it will go up. But yet again, from a technical standpoint, it's not good enough for an entry. Now the market is retracing, but I will subside the urge to enter on the leading candle. I will respect my method. Okay, Camarilla MACD is my own method, my own invention, and even if I had the feeling it will go higher, I will respect the method. The thing which I got when this candle closed was a perfect example of bullish divergence. So my method spotted divergence. Let's see where is the rule to enter the divergence. The rule is, I know what the rule is, and I will place an entry according with my rules. That thing is sitting at a pivot point, it's bullish, L3 is long level, so I have a triple confluence to enter the market. And what was that? The candle which gave me signal and entry was perfect, and the market of course went up in those direction. Those red, green, blue short lines are levels. Those are pivot points. Those are levels for trading. So we could see how executing a good plan will give you potentially nice profits, okay? So that is an example what I wanted to show you. And I think that we have reached the end. We have overshot our time for the webinar. If you have any questions, you can ask us now, but now you see the importance of having a plan, okay? Chris, mate, do we have some questions?
Yeah, one question about the red and green lines.
Red, green lines, well, if you think about those are levels. Blue line is pivot point, green line is short, short. It's a level for a potential reversal. A red line is a level for potential reversal for long side.
It's the Camarilla, basically, right?
Yeah, it's Camarilla, basically.
Yeah.
Yeah. Yeah.
And one question about from the earlier actually about a person, Hossein, who has a very good strategy, made good results, but you know, it has difficulties with the real account. Cannot keep the position. Sometimes close it with a few profit manually and fears loss. So
that's psychology, I think. I
yes.
think that is psychology. So basically, you need to have your plan written down. And then if you read it through it a lot, then you will adopt it eventually. So for me, it seems like
no, also maybe depends on how much risk is taken. You know, it's difficult to implement a plan when there's a lot of at stake, and it's easier if you maybe reduce it and practice step by step, maybe with a bit less risk than you've done so far. Maybe that's easier to have the stamina to try that at first.
Exactly, Chris. Yeah, the plan and the general guidelines will be available very soon. We are basically working on a great thing. We are working on a, you will see that. That will be a surprise for you because we are working on a trading plan template. It will be published soon when we finish, but basically that will be a nice thing, probably in the future. So stay tuned with us. That plan will be available, of course. And I don't think we have any more questions. Thank you, guys. It was great to repeat the most important lessons with you. Thank you, and thanks for listening to us. Have a great weekend, of course. I'm glad it was helpful. Thank you. Okay, now we can conclude the webinar. So guys, prior to entering any trades, ask yourself, are you able to trade? And if you haven't already made a plan and stick to it. Thank you very much for attending. Me and Chris wish you a heartily goodbye for now, and we will see you very, very soon. Okay?
Yes,
Many
indeed.
great tips to you.
Yes, indeed. Have a great trading day still if you trade tomorrow, and a great weekend as well. Cheers.
The organizer